Hello, everyone, and welcome to the next installment of our monthly educational webinar series focused today on business planning. I am Deanne Rosso, President and CEO of Vickery Financial Services, and I will be your host today, although not your presenter. Today, we are excited to have with us an expert in the field of business planning and business continuation planning to share his insights into what business owners should do to ensure they are properly preparing for the future. But before we get to the topic of the hour, just a couple of quick items. As I mentioned, this webinar is the next installment in our monthly webinar series. So head on over to vickeryfinancial.com to check the schedule and register for upcoming webinars. We've got some great topics coming up that might be of interest to you, so definitely check that out. And we do also record these webinars typically, and you can find those on our YouTube channel, which I will get Betsy to post in the chat box before we wrap today. Also, from time to time, we host in-person or virtual retirement planning seminars called Retirement Planning Today. And you can also find more information about those on vickeryfinancial.com, but we'd love to have you attend one of our seminars as well. I mentioned Betsy. Joining me today is our marketing coordinator, Betsy Harder. Hello, Betsy. Thank you for being with us today. We're glad to have you.
Welcome, everybody. Thank you for joining us. And I will be monitoring our chat box today. So if from time to time you have any questions for Brian, you can either put them in the chat box or you can put them in that Q&A box, and I'll be looking at both of those. And then at the end of the presentation, we'll go ahead and address some of those questions.
Sounds great. So put your questions in the chat box, and Betsy will get to those at the end of the presentation. So now on to the topic at hand, business planning. That's actually a really big topic, and it can encompass a number of different elements. But to us for today, business planning is helping our clients maximize the value they can realize for their business over time. And as business owners, you know, you spend years of your time and blood, sweat, and tears running and growing your business. But no matter what industry you're in, there are some common things you can do to help make sure that at the end of the day, whether planned or unplanned, your business is always ready for succession or continuation. So let me introduce our special guest speaker today, Brian Seigal of BUI, an insurance brokerage group out of St. Louis, Missouri. Brian is the Director of Advanced Planning for BUI, and he helps advisors add significant value to their client relationships. He determines client planning objectives, designs plans to achieve those objectives, and then coordinates the implementation of those plans. He also provides guidance and education for advisors and clients in the areas of estate, tax, and business planning. He's not currently practicing law at BUI, but he is an attorney, and he's been licensed to practice law in Missouri since 1996 and in Illinois since 1997. And through his prior experience as the owner of his own estate and business planning law practice, he provides guidance in the areas of estate planning, business succession planning, tax and retirement planning, and deferred compensation arrangements. He is the immediate past president of the Estate Planning Council of St. Louis and is a member of the Missouri Bar Probate and Trust Committee, the Missouri Bar Elder Law Committee, and the Missouri Bar Taxation Committee. He's certified as an accredited estate planner by the National Association of Estate Planners and Councils. He's a member of the Wealth Council and is a founding member of the Advisors Forum, which is an organization that trains attorneys, accountants, financial advisors, and insurance professionals to provide more comprehensive planning, increase their client referrals, and generate more revenue. He's quite accomplished. Brian was honored as one of Missouri's top estate and business planning attorneys in the Missouri Lawyers Weekly's 2009 Missouri's Best. And he was recognized as the top lawyer in the category. Now, this is very specific. Best lawyer to help you write your willful child out of your will. And that is very specific and sounds very interesting, and probably a topic for another day and another talk by Brian. But we're very excited to have Brian with us today to discuss failing to plan is planning to fail. So thank you, Brian, for joining us today.
Thank you very much, Deanne, and welcome everyone. Very glad to be here. And We'll start today in talking succession planning about what it is, because most people immediately think when they think succession planning, oh, we're talking about a transition of the business, a sale of the business, or it could be a transition within a family for a family-owned business. But that certainly is one aspect of it, that process for identifying a new owner. But the reality is there's a whole nother element that is too frequently forgotten, and that is finding new leaders as well, and transitioning the business to leaders who can successfully operate the business. So it's about finding new ownership, but in addition, you want to make sure that it's the right ownership that can continue to operate the business at a high level. And it's upon certain triggering events. Those triggering events can be, yes, death. It could be disability. It could be retirement. It could be disagreement among owners, or it could be an involuntary transfer. And I always get the question, well, what's an involuntary transfer? And the two most frequent examples are if there was a divorce of one business owner, making sure that the business interest doesn't go to a divorcing spouse. In other words, getting into the wrong hands potentially, beyond the scope of what was originally planned by the business owners. Or it could be a bankruptcy situation as well. So making sure that the bankruptcy trustee would not take control of the business in any way, and keeping the business within the ownership of the current owners. That's really the end goal with involuntary transfer. Yet it sounds really important to plan for business transition, but believe it or not, according to a 2016 nationwide small business owner survey, 60% of businesses with fewer than 300 employees actually have a plan in place. And by the way, yes, this is a 5-year-old survey, but the numbers don't change. They're always within that same range of usually 60%-ish. And with this survey in particular, the top reasons given for failure to plan, well, number one, it's not necessary. And I think it's not necessarily the business owners saying, oh, we don't need to plan for the transition of the business. I think it's that they don't see that they are going to transition the business at any point in the near future, and are thinking, okay, well, I'm still operating the business. I'm still running the business. I don't have any plans to transition the business right now. So there's no need to actually put together a formal plan. And as we'll see, that's not necessarily the case. Number two is don't want to give up the life's work. And that's 14%. And as Deanne said, business owners, we recognize that you put your blood, sweat, and tears into the business. And certainly, a lot of business owners spend more time in their business than they do with their own children. In essence, the business is their child, it's their baby, and they've raised it, they've built it from the ground up. And so they don't want to give that up. And I certainly understand that. That's a common concern. Not knowing when to create a plan. And I think that gets back to, okay, well, I'm not transitioning out now. So, when should I put together a plan? Why should I put together a plan? And again, and I'll get more into the details of why it's so important to plan. And I think it'll become pretty evident. And last is not having time to develop a plan. And we recognize that business owners are so busy running the day-to-day affairs of the business that it's hard to find time to do much outside of running the business. It's hard to find time for the family. And so, having time to do so, I know it can be difficult, but it's also incredibly important to take the time to do it. But in the end, that failure to plan unfortunately leads to business failings. And that is an estimated 30% of family-owned businesses don't make it to the second generation. You can see what happens to the numbers. 12% make it to the third generation, only 3% operating to the fourth generation and beyond. But it's incredibly important to have a plan in place to make sure that the business will succeed no matter what. And so today we're going to talk about the two sides of succession planning. Now, there are two distinct plans that should be in place for any business. One is for a planned exit, and I'm going to go into detail with that, but the planned exit really is when you are alive and well and looking to transition out of the business during lifetime. The other side is an unplanned exit. And that is an unforeseen event. It could be death, it could be disability, it could be one of those involuntary transfers that I mentioned, but nothing that's planned right now. But we want to make sure that, God forbid, one of those things happens, that there's a plan in place on how to deal with it so that the objectives of the business and the best plan to make sure it succeeds will be in place. So we'll start with a planned exit. So as I said, it's an exit during lifetime. It's a voluntary exit, and a business owner is dealing with known factors. That is, the business owner knows what the market is like. The business owner knows who a potential purchaser is, and has an opportunity to negotiate the terms of that sale. And ultimately, of course, being alive and able to negotiate, they also have an opportunity to accept or decline offers. And again, taking into account all factors as they exist at that point in time. An unplanned exit is an unforeseen event. And that's, again, you're dealing with the unknown. And unfortunately, what happens all too often is it's forcing the other business owner or owners to negotiate the terms of a sale, and potentially forcing the family to negotiate the terms of a sale of the business, which could put the family in a really difficult position. Because in the end, when the family is put in a difficult position, let's say that there are no family members involved in your business, then they're forced to jump in and keep a business alive and running until it can be sold, which can be a challenge. And frequently that leads to really a reduced sales price, and they have to accept an offer which is less than perfect. So the key is to have a plan in place to address that unplanned exit. Now, the most important reasons frequently that we hear of to plan for succession, number one, I don't want to say it's the most important reason, but it's the most frequent one that I hear from business owners, excuse me, is taxes. Whether it's potential estate taxation at death, whether it's income taxation. Right now, we have a bill pending in the US Senate, which would tax capital gains at death. And that's what President Biden has been promoting as well to pay for his infrastructure plan. Not making any political comments whatsoever, just stating the facts. And ultimately, the potential for taxation is significant, both during lifetime and at death, whenever the business is going to transition. And so having a plan in place to help minimize that taxation is key. In addition, minimizing risk. And there are all kinds of risks that are built into a lack of planning. And that is, I've mentioned several of them already, but I think the most frequent one that I hear is business owners concerned that their family is going to be put in a position where, the business would have to be transitioned out of the primary business owner's ownership, and it may end up in the wrong hands. It may end up in less favorable hands, or alternatively, if it has to be sold, then ultimately it may mean less revenue and maybe pennies on the dollar, worst case scenario. In addition, keeping options available, and usually that is for a lifetime sale of the business, which I'm going to get into in more detail. Control is a big one. That is, what is necessary to keep control during lifetime and make sure that there's going to be a successful transition, but also making sure that the business stays in the right hands if one of those unforeseen circumstances were to occur. And then last but not least is maximizing the value of the business and being put in a position to maximize the value, so that if it's a lifetime sale or if it's a transition at death or in the event of disability, that the sales price realized will properly reflect the actual value of the business, and it'll be at a maximum level. So a good succession plan is going to do a lot of things, of course, but I would tell you that, first and foremost, the primary concern that I usually hear from business owners is taking care of the business owner and taking care of the business owner's family. Those go hand in hand and are usually the first objective. But not far behind are also taking into account the needs of the other important stakeholders. And frequently that could be family members. But in addition, it's also going to be employees, it's going to be co-owners, and making sure that all these people are put in a position where they're not left for questioning, they're not left to worry about what's happening with the business. And a good planning process is ultimately going to involve all those people. It's going to, if nothing else, let the employees know there's a plan in place, and God forbid something happens, this business is going to continue, and it's going to continue at the same level. And there's no reason for concern if something should happen to the primary business owner. And in the end, that's going to make sure that the relationships are going to continue in addition to the business continuing. So the worst thing that can happen is that something happens to a business owner, the employees panic, and next thing you know, they start leaving, finding other employment. That usually is going to lead to the business failing to succeed, or failing to succeed at the highest level. So the common steps involved in developing a planned exit strategy. So again, this is the sale of a business during lifetime. The real common objective, the most common objective, is to have a smooth transition of the business. And yes, for the buyers or buyers, it's very important, because of course the buyer wants to make sure that the business is going to continue to operate at the same high level it was when it was acquired, or maybe even better. For the seller, and the seller may be relying on the success of the business to maximize the buyout, and we'll talk more about that in a bit. In addition, for employees, as I mentioned, and for the customers too, because you don't want to put the customers in a situation where they notice that there is a transition in the business and that things aren't running like they were. On Father's Day, I just was having a conversation with my own father, and they went to a restaurant that they'd been going to for years. And the restaurant was terrific. Literally, my folks went there every single week for probably the last 2 years. And there was a change in ownership. Well, what happened? For the first time recently, they noticed a significant drop off in the quality of the food, in the quality of the service. It wasn't a smooth transition. And he said, I don't think we're going to be going back there anytime soon. So again, that's a perfect example of how it can also affect the customers. They notice if there isn't that smooth transition in place. In addition, retirement income may be important. If you're selling your business during your lifetime, likely you're looking to maximize the value. And the reason for seeking that maximization may be because you want to make sure that you have sufficient retirement income. And so that's a very common objective for sellers of a business. So when you look at a planned exit, I talk to business owners all the time. Usually my first question is, okay, when do you want to exit the business? And the most frequent response I hear is, well, I would like to get out, within the next 6 months to year. And that sometimes can be a difficult accomplishment. It really takes a minimum of 2 years to put the books in a position to maximize the value of the company. I actually prefer up to 5 years and really develop that track record of success of the business. And not to say you can't sell a business if you've got a lead time of, say, 6 months or a year. But I will tell you that when transitioning out of a business, most buyers are looking at the last 2 to 3 years of financials for the business. So that's why I say it really takes a minimum of 2 years to maximize the value, but preferably even more than that. And it doesn't mean that you have to have everything figured out. It really means, again, that you're just going to start positioning the books in a way where it's going to maximize the value. My next question to every business owner is, okay, who is the potential successor? Is it going to be a family member? Is it going to be a business partner? Is it going to be a third party? Potentially could be a friendly competitor, what I refer to, and I'll talk more about that shortly. But identifying that successor is usually going to be the first step after determining what the time horizon looks like. Then, how much of the business is going to be purchased? Initially, is it only going to be a minority interest? And then over time, a majority interest? Is it going to be 100% of the interest? And of course, looking at the value of the interest that's going to be purchased, but also how's the purchaser going to pay the purchase price? Is it going to be installment payments over time? Is it going to be in a lump sum? Are they going to go out and get a loan to pay the purchase price? And each one of those potential options is very different and brings different risks to each party. And then last but not least is the seller's involvement necessary to make sure that that transition is going to be successful? And frequently the answer is yes, it is going to be necessary for a period of time. And again, there are several ways that a business owner can stay involved with the business before actually completely transitioning out, to make sure that that is going to be a successful transition. So looking at who the potential successor is, I mentioned it could be a business partner. That's always an easy one. When you're talking about a family member, sometimes I am working with a business owner with children involved in the business, or it may be one child involved in the business, two who aren't. Sometimes it becomes a question of not necessarily true succession planning. In other words, not having a sale agreement in place, but instead making it part of the estate plan, and making it part of the estate plan to make sure that the business ends up in the hands of the child or children who are involved in the business, and doesn't end up in the hands of those who are not involved in the business. And there are ways to make sure that the business does end up in the hands of the children who are involved in the business, and yet equalize the estate distribution to those who are not involved in the business. I literally, over the weekend, was involved in a discussion with an attorney who deals in this area. And he was telling me about a situation, a client that he met with on Friday, who has 3 children, and the client had 3 children. The client unfortunately passed away, and he left the business to all 3 children. And only one of the children was involved in the business. The other 2 were not. And the children were in a major fight, or are in a major fight at this point, because they're disagreeing on how the business is going to be run, because it's 3 children equal 1/3. The one child involved in the business is only going to have a 1/3 interest. And so the other 2 children not involved in the business can outvote the other child. So it's not a good situation. And again, having a plan in place that's going to equalize the estate distribution and make sure that the business ends up in the hands of the child who is involved in the business, and other assets go to the other children, usually is not only going to be successful for the business, but more importantly, it's going to keep family harmony as well. It could be that the successor is going to be a key employee. And sometimes I hear from business owners, well, I have this employee who would be great, has the ability to run the business, but would never have the wherewithal, the financial ability to buy it. That's something that we can always plan for. The key is, are they the right person to take over ownership? And in addition, do they want to take over ownership of the business as well? And then it could be an outside third party. Again, I mentioned it, what I refer to as a friendly competitor frequently. And it could be just a third party, another company looking to make an acquisition, but looking outside. And frequently there are business brokers who will bring together parties for that reason. But again, looking to a third party, someone who's not already involved in the business or not a part of the immediate family. So the next question becomes, how much of the business is going to be purchased? And I mentioned that it could be the entire interest, the controlling interest, minority interest, and it's different for every business. So every company has a different plan. And part of the answer to that also could be dependent on whether the seller needs to remain involved in the business. And make sure that it's a successful transition. Um, what I hear from business owners a lot is, well, I want to transition minority interest to start, and I want to see how it goes. And then if things go well, then I'll sell the next tranche of the business interest to the purchaser. And is it going to be an asset purchase, or is it going to be a full purchase of the entity? An asset purchase leaves out one particular item, and it is selling assets of the business to the purchaser, but it's not selling the actual business or the liabilities to the purchaser. And so, depending on the type of business, depending on the advice that the purchaser is receiving as well, it may make more sense for them to seek an asset purchase as opposed to a purchase of the full business interest. And that can have an effect on the purchase price as well. Is goodwill going to be included? Is goodwill not included? If there are potential liabilities, then if the liabilities are not being taken on by the purchaser, then it may be that the asset purchase could actually yield a greater sales price for the seller. So it just depends on the circumstances, but it's always something to think about. Does it make sense to sell the assets or sell the entire business interest, including the entity itself? All right, so the most important part and the most frequent questions I get are related to value of the business. And if you're looking to sell your business during lifetime, you should absolutely have a formal valuation performed by a business valuation expert. They're not inexpensive, but at the same time, you have one opportunity to sell your business, one opportunity to maximize the value of that sale. And so you want to make sure that you get it right. And so having a formal valuation performed is going to be really important. If you're looking down the time horizon and thinking, okay, well, it's going to be 5, maybe 10 years before I actually transition out of the business, you may want to consider an informal valuation. A lot of valuation firms will perform what's called a calculation of value. It actually does look at market comparisons and will take financials into account. It just doesn't do a deep dive like a formal valuation would, but a calculation of value will generally provide a range, where the formal valuation will pinpoint a value and say, here you go, here's what the approximate value of the business is. The informal valuation will provide a range. The formal may say the business is worth $5 million. The informal might say it's worth the range of 4.6 to 5.4 million, somewhere in that range. So it could be a lot less expensive. So that's why I say if it's 5 to 10 years out, you're not looking at that major cost of a formal valuation, but at the same time, you're getting some pretty good data back on what the range of values might be. When looking at the sales price of a business, and specifically what a buyer is willing to pay, they're usually looking at the net cash flows of the business. And that's because the question in their mind is, how long is it going to take for us to recoup our investment before we are actually turning a profit? And that time horizon most frequently is going to be 3 to 5 years. And 5 years sort of being that magic time frame where they feel like they paid for it at that point. Now they're going to start receiving the net profits as opposed to just paying them back for the purchase of the company. There are some businesses who like to use a multiple of EBITDA, that is earnings before interest, taxes, depreciation, and amortization. That can be appropriate as well. There are some who look to a multiple of gross revenue. I'm usually not a fan of looking at a multiple of gross revenue because that doesn't really tell the full picture. Again, what's most interesting to a buyer is going to be net profit. What am I actually going to get when I sell this business, or when I purchase this business? What am I actually going to receive as the net profit as opposed to gross revenue? So again, not a big fan of gross revenue, but the multiple of net profit, depending on the industry, could also be a pretty good measure to at least give a ballpark estimate of what the value of the business would look like. And so then we get to, how's the purchaser going to pay the purchase price? Well, frequently it's going to be through installment payments. And that is payments over a period of time. This would usually necessitate the immediate transfer of the ownership of the interest of the business to the purchaser, which, keeping in mind, is also going to transfer the net profits of the company. So the net profits, in essence, can be redirected to pay to the seller of the business. They're just not receiving them as net profits. Instead, they're receiving them as the purchase price or the buyout price. And keeping in mind that if there is a smaller ownership transfer, then it's going to be a smaller amount of the profits that will transfer as well. So it often comes down to the numbers and how they work out. But again, taking into account multiple factors, including if there's going to be a sale of a minority interest because of control concerns, then that has to be taken into account when figuring out also how much of the profit is that going to transfer, and if it's installment payments, is that going to be enough, the transfer of the profits, to make full payments for the interest in the business, whatever the installment payment is going to be. And of course, with an installment payment arrangement, success is always going to depend on the continued success of the business. So if the business at any point isn't generating generating the same net profit, if the net profit would go down in any way, unfortunately, those net profits may no longer be enough to support the payments to the seller of the business. And so that sometimes can lead to some difficulty with the plan. So the other option, or another option in addition to installment payments, is third-party financing. Usually that's going to be going out and getting a loan from a bank. And of course, it completely depends on the credit worthiness of the buyer, which the seller, in the end, it doesn't really care. If the buyer can get the loan, that's all they care about. And the seller usually doesn't care about the state of the credit markets either in a lifetime transfer. As long as the buyer can get the loan and pays the full purchase price, then the seller is happy. The buyer just has to be concerned with these things, and that's all part of the negotiation of the sale of the business. So the last factor being, is the seller's involvement necessary? And what we see oftentimes is that the seller will remain involved in a consulting agreement. So will still be involved to the extent that the buyers need the seller to be involved. In addition, some other considerations are: the buyer's job responsibilities going to increase? If the seller were to step out completely, then who's going to step in to take over the functions that the seller was performing, assuming that the seller was active in the business? That could mean additional salary that has to be paid to another individual or individuals who would have to be hired to take over those responsibilities. And that could mean less net profit for the company then. So again, all kinds of factors that are interrelated. Is the seller going to maintain any kind of control? And if not control, is the seller's involvement necessary to continue managing the company? Some sellers of a business are extremely involved, and to the point where they are running the show. And so the thought here is, if you're running the show, if you're running your company and no one else has that management experience, is your involvement still necessary to the point where you've got to stay involved for a period of time to transition that management to other managers? In some situations, it may be appropriate for a seller to remain on as an employee and receive salary for the job. That is another way of staying involved and, again, being compensated for it. And something that I see is missing in a lot of lifetime sales is a non-compete or non-solicitation agreement. And the last thing a buyer wants is to purchase a business and then have the seller turn around and solicit the customers of the business for a new venture, or to open a competing venture. So having a non-compete and non-solicitation agreement is usually going to be really important to include for any buyer. For the seller doesn't care so much about that. So The structure of a sale comes down to it's involving also how the purchase price is going to be paid. Is there going to be a down payment? If so, how much is that down payment going to be? Recognizing that a larger down payment is going to decrease the amount that has to be paid through installment payments. If it's going to be a loan, what's the loan term and interest rate going to be? Of course, the buyer is going to be more concerned about that than most sellers would be. Is there going to be an earnout where the purchase price, the end purchase price, is ultimately going to completely depend on how much of the business is retained and the revenue stream that is retained? And that's a common way, depending on what type of business we're talking about. A lot of service-oriented businesses will have some form of earnout. Or, as I mentioned, salary as an employee. It may be that part of the purchase price could be actually made up as salary paid to the exiting seller as an employee. All right, so I'm going to jump over to the emergency exit plan, the unplanned exit strategy. And remember, so far, I've been talking about the sale of a business during lifetime. Well, here, we're talking about the unplanned exit. There's no lifetime plan to sell the business at this point in time. However, it's having that emergency plan in place to make sure, God forbid, something happens to an owner of the business, then there's a plan in place on exactly what's going to happen. And in the end, the objective is frequently for every business owner, as I mentioned, to make sure that the family receives full and fair value for the interest in the business, and they're not leaving their family in a position where they have to step in and run a business where they don't have the experience to do so. It really is prearranging all of the terms of a sale of the business so that there's nothing left to negotiation. There's nothing left to worry about. And from the other side, if it's a business that you are owner of, and let's say that you've got two business partners, there are three of you. Well, the three of you probably would like the spouses, or probably do like the spouses of your co-business owners a whole lot, but wouldn't necessarily want to own the business with them. So making sure that the business stays in the control of the other owners is usually an objective. And in the end, making sure that in addition to the family and other business owners being taken care of, that there are assurances in place for employees, customers, and creditors to make sure that the business is going to continue at the same high level, even if, again, something terrible has happened to one of the business owners. So with an unplanned exit, it really is the same question. Who is the successor going to be? We don't, of course, have to address the question of what's the time horizon, because we're planning for an unforeseen event. But at the same time, we do have to know who the successor is going to be. The value of the business is also going to be important. I'm going to talk about some of the ways of determining that value, how the purchaser is going to pay the purchase price. You've got some more limited options here. And then whether the seller's unplanned exit poses any additional risk to the company. If the owner was the primary manager of the company or was performing tasks on behalf of the company that it wouldn't be easy for someone else to do, that could pose additional risk. So first, who is the successor going to be? Well, if a co-owner is going to be the successor, that is a pretty easy situation. If the family member, a family member is going to be the successor, it comes down to that same question as a planned exit. Is it better off to be addressed through the estate planning or through a true business succession plan? Is estate equalization, again, something that is important? Are there multiple children, but only one or two involved in the business, and the other or others are not involved in the business? And again, that's where the estate plan, whether it's a will or a trust, can help make sure that the business ends up in the right hands and that the family isn't put in a position, the children are not put in a position where there could be some significant discord within the family. It could be a key employee again. And as I mentioned before, frequently I hear from business owners that, yeah, that's the right person to take ownership, but they wouldn't have the wherewithal to pay for the business. And it's a little bit easier in this context in an unplanned exit to be able to provide the funds for them to do that. And I'll talk about that shortly. And again, it could be an outside third party, and that's where a friendly competitor may make a lot of sense. A couple of years ago, I was working with an advisor and a dentist who was the owner of a practice and didn't have any other employees other than a couple of assistants working in the business. And I asked who the successor would be, and he said, I really have no idea. I don't have any plans to hire anyone else to, train them to take over for me. And I asked the question, well, are there any others in your field who are relatively close geographically? And he said, yeah. He said, actually, I have a good friend who's about 5 miles away. And they ended up working out an arrangement where they obligated each other to buy each of their practices in the event that something happened to them, an unforeseen event happened to them. So that's a perfect example where, again, an unforeseen event could make sense for a friendly competitor to step in and purchase the practice under those circumstances. All right, so then we get to the question of what's the value of the interest being purchased? And with an unforeseen event, what I like to consider is what's called a certificate of agreed value. That is, for the business, each and every year, the owners get together and decide in an annual meeting for the next 12 months, here is the value of the company for a buyout if there is an unforeseen event that would occur, if we have an unplanned exit. And if there is no certificate of agreed value that's been put in place during the prior 12 months, then it would default to another way of determining the value. Usually it would be a formal valuation, an appraiser coming in to value the business or something along those lines. It may be another formula based on the industry. But at least the certificate of agreed value would provide an opportunity for the owners to revisit the value on an annual basis and to set it on an annual basis for the next 12 months. And here, when we're talking about planning for an unplanned exit, I don't recommend going out and having a formal valuation performed. The truth is that we're not anticipating that there would be an exit in the near term. And so to spend the money on a formal valuation may not be prudent. If anything, an informal valuation may make sense, again, because the cost is going to be significantly less, number one. And number two, it provides that range. But again, I still think that above all else, the certificate of agreed value is going to be preferred. And you get to the same questions. And sometimes these are formulas that are built into the buy-sell agreement, the agreement that's going to obligate a party to buy out the interests of a deceased owner or a disabled owner. Sometimes the formula is going to involve the cash flows, the net profit of the business. And it's going to be some form of a multiple, maybe, of EBITDA or net profit. I still don't like the great gross revenue, even for an unplanned exit. It just isn't one that makes sense to me because it doesn't truly represent what the profitability of the company is and what the value of the company is in turn. So then we get to how will the purchaser pay the purchase price? This is a little bit different than the lifetime buyout because here, what's optimal is a lump sum. And to be able to pay the buyout price in one fell swoop makes a lot of sense. And it can be done pretty easily. You look at a death situation, and if, God forbid, one owner passed away, if there was life insurance in place to fund the buy-sell obligation, well, you're paying pennies on the dollar to leverage up into a much larger life insurance death benefit that pays out when it's needed and only when it's needed. And so, again, it's an effective way to pay for the purchase price if that situation ever arose. And most frequently, it's going to be term insurance. So we're not talking about any kind of expensive permanent insurance. You're trying, again, to leverage up a much smaller amount into the ultimate purchase price. There's also what's called disability buyout insurance. And disability buyout insurance is insurance that Works like life insurance, except it doesn't pay out in the event of death. It pays out in the event of disability. It'll pay a lump sum if there's a permanent disability, and a buyout would be triggered through a buy-sell agreement. There are also installment payments. Now, this always gets a little more dangerous in the unplanned exit context, because if the owner is no longer around to run the business or to stay involved in the business, again, that's not an option here, then the success of the business is really going to determine whether the installment payments can continue to be paid. So there's always a greater risk if the seller, if the owner, who is now deceased or disabled, was instrumental in running the business. It could also be, again, third-party financing. This is, again, more dangerous here, because we don't know what the credit markets are going to be like when this unplanned event would occur. It could be like 2009, when the credit markets weren't very strong at that time, and it was hard to get a loan. So that's always a little bit dangerous. The last option is a sinking fund, which is literally taking money from the operating revenue of the company and putting it into a side fund. That's always dangerous as well, because what I found is that two things. One, when a company has the need for cash, what's the first place that generally you're going to look? The sinking fund. It's cash that's sitting there, that's available. And number two is you spend time building up this sinking fund, and it does take time to build up. And next thing you know, by the time you finally build it up to your goal, the business value has increased significantly, and it's no longer enough. And you have to continue to play this game of chase to try to make sure that the sinking fund is going to provide enough to pay the full purchase price. It can be a really good source of a down payment, and then relying on installments for the remaining balance. And so using a combination of approach in the agreement is usually going to make sense. Life insurance, again, potentially disability buyout insurance, those are the easy ones, because they're just going to pay the purchase price. The other methods are going to determine a little bit more work to make sure that the business can sustain the type of installment payments we're talking about, or that the credit markets are still sufficient. So I mentioned a couple of times a buy-sell agreement, and I would be remiss if I didn't give an example or at least provide a definition. A buy-sell agreement is a binding written agreement that ultimately determines what happens with an interest of an owner in the event of one of those triggering events that I mentioned earlier, whether it's death, whether it's disability, whether it is an involuntary exit. It could be retirement, and it may be just if the parties aren't able to agree on something else, then this is the default of what would happen. And I think one important key here is that a buy-sell agreement should always be drafted by an attorney who is practicing in the area of estate planning, corporate planning, or ultimately in the mergers and acquisitions area. I had a situation a few years ago where I reviewed a buy-sell agreement, and it didn't fit the scenario of this business at all. And during a call with the owners, I asked, so out of curiosity, uh, is your attorney that you used a business planning attorney? And one of the owners said, oh, he said, we didn't use an attorney for this. I actually found a form on the internet and just changed the information to be our business. Don't do that. They would have had major adverse income tax consequences if something had actually happened to one of them. So you want to make sure that it is drafted by someone who knows what they're doing. I know it's expensive oftentimes, but it is well worth the funds, because it's going to save a lot of difficulty and a lot of potential, again, adverse consequences, whether tax or otherwise. And then in addition to having the agreement, it can be funded versus unfunded. Just jumping back to the way that the purchase price can be paid. A funded agreement is one where the funds are set aside either through a sinking fund, or it could be a lump sum through insurance, but those are funded agreements. Unfunded agreements are relying on solely installment payments or getting a loan. And it's unfunded because there's no set way, there's no guarantee that the funds are going to be available when they're needed. So having a funded plan is always really important. All right, so the last element here I want to point out is how important you could be to operating your business. And if something did happen to you, what kind of impact would it have on your business? And you can see here from the cartoon, it's one of the advantages of having your own business, and it is the owner who is the employee of the month. And it's of course funny, but at the same time it is so true that frequently business owners are the employee of the month or employee of the year or employee of the decade for their business. They're so important to the success of the business, and they are key to the business, and it's key person planning. And I liken key person planning to the game of Jenga. Jenga is a tower of blocks. As you pull each block out, ultimately you try to make sure that the tower doesn't collapse. Well, when you pull out a block and that tower wavers back and forth, that is the key person, because there's a risk to the company at that point in time that it could come crashing down. When you, of course, pull the block out and it comes tumbling down, that is the absolute key person, where the company cannot survive without the involvement of that key owner. And frankly, active owners provide valuable services to the company. It could be having special contacts or connections and having the important client relationships, having a unique sales ability. It could be financial expertise. It could be that it is product innovation or design, or just having leadership skills and having the ability to run the business at a high level that it would be difficult to maintain that same level of success without the owner's involvement. And the risk to the company, well, potential increased costs in having to hire multiple individuals maybe to take over the tasks that the owner was performing. It could, one of the biggest risks is customers leaving and moving to a competitor, or employees again leaving because they're concerned the owner was running everything, was really the straw that stirs the drink, and suddenly they're no longer there. That can raise some significant concerns. And those things in the short term could lead to reduced revenue, reduced profits. And so there has to be some kind of plan to address that risk. And that's where with key person planning, it's usually pretty easy. Key person life insurance is frequently purchased by the company. It is insurance that's not there to support the sale of a business. It is there for the company itself. The company is the owner and the beneficiary of a life insurance policy. God forbid that owner passes away, the death benefit pays out to the company, and the company has the funds necessary to pay for increased costs or to potentially make up for lost revenue, reduced revenue, or profits in the short term. So it really can provide some important influx of cash into the company when it would be needed. And the other aspect is, if an owner were to pass away, and I hear this a lot, well, yeah, if I pass away, then I have a few key people who would be able to step up and run the business just as I was running it. And you don't want for there to be uncertainty after an owner passes away. And of course, there is always the risk that an employee would leave if there was uncertainty surrounding the business. And so this is where it's really easy to put into place what's called a stay bonus or retention bonus. And it is taking those few key employees, or it could just be one key employee, and telling them, look, if the owner passes away or becomes permanently disabled and exits the business, then we will pay you a cash bonus of X amount. It could be 100,000, it could be 300,000, it could be 500,000, it could be $1 million. If you stay with the company for a period of a year or 3 years after something again has happened to that business owner, a way of making sure that the important people are sticking around so that the business can help keep that high level of success and won't see potential risk beyond that. So it'll help ensure that the business does survive ultimately at a very uncertain time. So I know I've given you a lot here. The next steps of any planning process are always to meet with your planning professionals to help develop a planned exit. If you're looking at a 2 to 5 year exit plan, then making sure you're taking those steps to really set the course for the successful transition of the business. But regardless, every business should have an unplanned exit strategy and should have a buy-sell agreement in place and should make decisions about funding that buy-sell agreement, whether insurance is going to be included or otherwise. But in the end, ensuring that the business isn't going to be placed at risk. And that includes if any business owner were to pass away or if a key employee were to pass away or leave. That's another one that I hear a lot is, okay, well, I'd be in a world of trouble if I lost my right-hand man or right-hand woman. And if that were the case, then there are ways to incentivize them to stay with the business as well through executive benefit planning. Something that you do have available to you at no cost is a review of any buy-sell agreement, your succession plan as a whole. You complete an information gathering document. It automatically is uploaded to me, and I perform a review of the buy-sell agreement, make sure it plans for everything it should, and ultimately we have a meeting to review my findings. And if there are updates that are necessary to the agreement or to the funding, then of course we review what the options are and how to address that exactly. But it's a process that is designed to make sure the plan is doing what you want for it to do. And if you don't have a plan in place currently, specifically on the unplanned exit side, because again, every business should have one, then it's something where we can meet and I can at least talk you through. As Deanne mentioned at the beginning, I'm a non-practicing attorney. I serve as a consultant now, but this is a process that would come to you at no cost. So something that is just designed to help put you in a better position to understand where your succession planning is in relation to where you want for it to be. So with that being said, again, I know that's a lot of information. I think we have a few minutes available for questions.
Thank you so much, Brian. That has been very great information for me personally, and I'm sure for all of our attendees today. We do have a question that came in. Do you recommend that the two parties agree ahead of time on a consulting company to do the valuation? Or should each party have their own separate company doing a valuation and then compare the two?
Yeah, it's a great question. And I don't like building into a buy-sell agreement a specific company because things can change. And what I find is that the agreements don't always get updated to reflect the changes. So that being said, I think that option 2 there, each one having their own valuation performed, each side having their own valuation performed, and then hopefully they're within a certain percentage of each other as far as value goes. If not, then that's where each of the valuation experts would then hire a third valuation expert it gets very expensive, but they would find that third valuation expert to come in and provide the tie breaking, if you will. And sometimes it's an average of all three. Sometimes it's taking whichever one is closer to the third valuation. But it can be done in different ways. But the bottom line is, I don't recommend building in a specific valuation firm just because of the potential change over time that may occur. The company could no longer be around, or the relationship with that company may have changed. So better to leave things a little more flexible.
Okay. And then similarly, should each party have their own attorney and own accountant reviewing things on their ends?
So that is completely dependent on the circumstances. If it's a sale to a third party, certainly each side should have their own consultation with their own professionals. If it's a sale between business owners to current owners, I still think that they should have their own representation legally. On the accounting side, sometimes the accountants will actually represent the company itself and not either one of the individual owners, and the owners are comfortable with that. So I think from an accounting standpoint, maybe the CPAs, there can just be one. There doesn't have to be two separate ones. But definitely on the legal side, I always recommend having their own separate attorneys to help negotiate, to help give counsel, because otherwise there's a significant conflict of interest.
Very good. And everybody who's watching, if you have any questions, feel free to type them in that chat box. One other question is, so when a company is looking, or an owner is looking for a company to help them with their transition, what types of things should they look for in that company? What type of experience in order to pick the right company to help them?
I think it's experience in your specific industry. So making sure that they have a lot of experience. So I mentioned dental practices earlier. There are specific companies out there who that's what they do, is assist either dental or medical practices with transitions. So I think having entities that have the experience and knowledge specifically in your industry is going to be most important.
Excellent. Those are all of our questions that have come through so far. And one person would like to know if your slides would be available for us to send out to everybody after the presentation.
We can absolutely make those available. Yes.
Excellent. And if anybody has any further questions, feel free to send them my way. And it's marketing@vickeryfinancial.com. And I'll make sure that those get to Brian and that we can have them answered for you.
A couple of quick questions for Brian, if we have another minute.
Sure.
So at one point you mentioned, putting the books in order for a transition takes a while. So what do you mean by that specifically? And what can we as business owners do day to day to make sure that the books stay in order?
Yeah, usually it comes down to maximizing net profit. And that's sort of, again, the end all be all, because it always comes back to, for a buyer, how are they going to maximize, or how are they going to maximize the profitability, and over what period of time are they going to turn a profit? And so for the business owner, just being able to maximize that profit. And when you're selling your business, the greater the profit, the greater the sale price is going to be for the business. So I think it really comes down to maximizing the profit, the net profit that's shown on the books.
Mm-hmm. Yeah, and I'll also say I think a challenge sometimes that my small business owner clients pose to me is when they get ready to retire, they're not actually sure what income they need in retirement, because a lot of their expenses, if you will, have been taken care of over time by the business. So would you say that it's important to really keep the books clean and kind of separate that personal versus business expense, not only from a personal standpoint of knowing, what you need to retire on, but also from a business transition standpoint?
It is so important. And I think it's important, yes, number one, for retirement planning purposes, and sort of going along with that, number two, that just shows the importance of bringing all the professional advisors together as well. All too often what we see is that the attorney is operating independently of the financial professional, who's operating independently of the CPA. And when all the professionals are brought together, that's when all the goals and objectives are taken into account, at least with every decision that's being made. And again, I think that is probably one of the most important aspects about a business transition, for that exact reason, is bringing everyone together, because you're going to have a perspective that the attorney is not necessarily going to have. The attorney is just looking at, okay, how can you get out and how can we maximize the value, isn't always taking into account every other detail. And you've got a whole nother angle that you're looking out for your business owner client with. And so I think it's just really a great point and an important one to make sure that everyone's involved in this process. It's not just the attorney, it's not just the CPA, it's everyone.
I would agree with that. I think that's one of the things that we really enjoy about working with our business owner clients is, helping to coordinate that relationship between all of your different professionals and look at it from all different angles. I think another key point that you highlighted today, you spoke a lot about key employees and employee retention and utilizing those key employees in your succession plan. And I think that sometimes something we overlook as business owners is identifying those right leaders and developing those right leaders over time. So, when you talk about needing time, needing 2 to 5 years to prepare for a transition, I think a lot of that goes into developing those key employees, developing those relationships. And as a business owner, we often want to hold on to that control, but delegating some of that control and developing again those key people in our business in order to build them up to be able to have a successful transition. Would you say that that's accurate?
I would. And yeah, I actually a couple weeks ago just had a conversation with a business owner here in St. Louis. He's the longtime owner of a very successful electric company and electricians. And he has a son who's involved in the business. And again, I asked the question, when would you like to exit the business? His answer was, yeah, preferably within a year, but I don't think my son will ever be ready to take over within a year. And I asked, well, okay, so your son's the successor. So what kind of plan do you have in place to actually teach him the ropes and to put him in a position to be able to take over the business? And that's when I got a blank stare back. So absolutely, to your point, that 2 to 5 year plan has to not only encompass the books and making sure that the books are in a position to maximize the value, but in addition, if that successor is going to come from within, it is so important to start that grooming process and really to develop the future leadership and future ownership. But I think more importantly, future leadership to take over as leaders to make sure that that's going to be a successful transition, especially when the business owner is going to be relying on retirement income coming from the business sale. Because otherwise they're putting their retirement at risk by not having that full plan in place, and that full plan to make sure leadership is going to be appropriate.
Mhm. Yeah, I agree. And I just have one last comment / question, I think, to wrap us up for today, unless Betsy has any other questions. But I often hear from some of my small business owner clients that they're not sure their business is worth anything, that they're not sure that beyond them it really exists, that they plan to sort of, die with their boots on, or, whatever it is. And what would you say to business owners like that? Because in my experience, I feel like I see a lot of small business owners who think that way, but I believe there is actual value in their business.
No question there is. And there is always value to the business. If you have customers, there's value in that. And so specifically, I hear that a lot more from sole business owners where, they feel like, okay, well, the business is me. I'm operating it, and it may be a professional organization. I've heard that before from professional CPAs and attorneys saying, "Yeah, I don't know I would just close the doors at that point, or my family would just close the doors." But number one, having a plan in place to make sure that someone is going to take care of the customers, that's value in and of itself, of course, just to make sure that customers are taken care of. But in addition to that, there is value in having a customer base, in having a business of any type, of any size. And so sometimes it may be that you don't have to go out and have a full valuation done. It may be that there's a formula built in with a friendly competitor who would step in to buy out the business interest, and having a formula for that purchase price. There are ways of valuing the business. But there's always going to be a value associated with it. And it's just a question of, okay, what do you want to see happen with the business? Would you want for your family to receive some value if something happened to you, or when you transition out? Or, and I still hear from some business owners now, I just would close the doors at that point. Or when I retire, I'm just going to close the doors. And that could be closing the doors to some potential return for having built the business or practice over time as well.
Yeah, good. Really great stuff today, Brian. Thank you so much for joining us. The presentation was awesome. Thank you so much for answering our questions. If we didn't get to your question today, just feel free to send an email to events@vickeryfinancial.com. We'll be sure that we get an answer to your question. Or if you have a personal question, feel free to send us an email, and we'll get back to you with an answer. Also wanted to give a quick shout out to our friends at First Element Insurance Planners. Brian is a consultant with First Element, and we work hand in hand with First Element to make sure that not only that our business owners get a review, like Brian mentioned, of their buy-sell agreements or their business succession plan, but also that all of our clients can have the opportunity to have their insurance plans reviewed. So if that is of importance to you, feel free also to reach out to us, and we'd be glad to connect you with the great folks over at First Element. But thank you so much for joining us today. We really appreciate your attendance in this webinar. Check out our website for more upcoming webinars, and we hope to see you at the next one.
Thank you so much, Brian.
Thank you. Thanks for having me.